Market news. Kapiti Coast financial advisor Chris Lee says rest home operator Arvida should not have done a discounted placement to outside investors so soon after its December float. Late last month, Arvida raised $30 million from an underwritten placement priced at 84 cents per share, and its retail shareholders can participate in a 5 million share purchase plan at the same price, but are limited to a maximum of $15,000 worth of shares. The $41 million raised will be used to fund a $62 million purchase of 3 aged care facilities in Auckland. More than half of the placement went to 2 institutions, ANZ Funds Management buying about 7 million shares and British-based Artemis buying nearly 13.1 million. Both institutions had small stakes in Arvida before the placement. Arvida raised $80 million in last year's float priced at 95 cents per share, with the funds used to combine 17 retirement villages. Care beds made up 54% of Arvida's facilities, with 84% of its care revenue coming from the government, much higher than other retirement village operators. The 3 new villages have 295 care beds, 70 service departments and 9 new independent apartments. Mr. Lee says if the deal had any merit, why not offer it to those brave souls who outlaid 95 cents a few months ago? The share purchase plan is tiny, and Arvida has given away the majority of the discount to its broker and friends and also paid an underwriting fee to the broker. And nobody wants to ask why, he said. Mr. Lee says he wonders if the Shareholders Association has a view on this. It's well known that the association generally opposes such methods of raising capital, preferring that renounceable rights issues be used instead, except in exceptional circumstances, because that allows all shareholders to participate on an equal basis. For more on this story, go to nbr.co.nz. To Chorus. Chorus has been downgraded from neutral to underperform by Forsyth Barr in the wake of the Commerce Commission's draft final decision on copper pricing yesterday. Forsyth Barr has also chopped its 12-month target by 13 cents to $3 and reduced its 2016 net profit pick by 35% to $64 million and its 2017 net profit projection by 16% to $74 million. First New Zealand Capital has kept Chorus at neutral and upped its 12-month target from $3.14 to $3.27. First New Zealand Capital sees long-term upside for the company. Following yesterday's final draft, its picking dividends will resume next year at 16 cents per share, up from its earlier pick of 14 cents, rising to 28 by 2020, up from its previous forecast of 24 as the UFB rollout completes. The regulator's headline decision on copper line pricing was favourable to Chorus, or at least a lot less bad than its initial ruling. But as NBR noted yesterday, there were also a couple of knockbacks for Chorus. One, the Comcom decided not to backdate its decision. Given its final draft was higher than its 34.44 initial ruling, backdating would have been a nice windfall for Chorus. Forsyth Barr senior equities analyst Blair Galpin puts the backdated revenue at near $82 million. All elements of the final draft, including backdating, will be finalised in December. FNZC Head of Institutional Research, Ari Decker, says we absolutely expect backdating to be challenged by Chorus if it's finalised in the ISP's favour. 2, the Comcom gave ISPs a decent consolation prize by knocking substantial amounts from one-off fees. 3, the higher-than-expected pricing is being phased in over 5 years. Next up, in early 2016, the regulator will investigate the non-price elements of Chorus unbundled bitstream access, UBA or broadband pricing. And around the same time, a sweeping review of the Telecommunications Act will begin. Once the UFB rollout is complete, it's far from clear if the Comcom will treat Chorus as a regulated utility in the manner of Vector or allow it a freer hand on pricing and profit margins. The brighter news, Forsyth Barr expects Chorus to resume dividends in the first half of 2016.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland. Last month's Court of Appeal decision against Trustpower in its dispute with Inland Revenue is an ugly result for the company, but also has very worrying implications for a wide range of companies, according to Ernst Young tax partner Dave Griffiths. Joining me for more on that story is NBR journalist Jenny Ruth. Tell me more.
The Court of Appeal ruled that $17.7 million that Trustpower had spent on feasibility studies, including getting resource consent applications, can't be treated as a normal business expense and deducted immediately for tax purposes. The court saying instead that spending should be treated as capital spending and depreciated against the eventual asset. The EY tax partner, Mr Griffiths, is arguing that the problem there is that there may never be an asset to depreciate because companies like Trustpower do feasibility studies all the time, and they apply for resource consents. And he points out if you apply for a resource consent, you don't know ahead of time what the conditions are. You may get your consent, but the conditions may be such that it's not commercially viable to proceed. And he's saying that by making this ruling, the Court of Appeal has created more black hole expenditure. Now, that's something the government has been working very hard on eliminating.
And also, it suggests that the Court of Appeal's decision has gone much further than Inland Revenue's initial argument.
Yes, well, IRD was just arguing that that consents, resource consents themselves were an asset, but the court has, basically brought into question all feasibility type spending, and it's very unclear now how far IRD is going to take this. You could conceive of, if you have a chief executive who spends, say, half their time investigating expansion opportunities, is half that chief executive's salary at risk now?
And Mr. Griffiths from EY suggests that there may be many other situations where this Trustpower decision could have an influence, such as Ports of Auckland and Wellington International Airport.
He didn't suggest that. That was my suggestion, actually. But
okay.
You don't have to think very hard to think of situations that could come under the scope of this decision. Ports of Auckland did incur a lot of costs in planning two extensions to its Bledisloe Wharf. And then after a big political stoush, it agreed with Auckland Council it would only proceed with one of them. So, that's another situation where there won't be an asset, but there was expenses incurred. Wellington International Airport, they've already spent millions in trying to get the runway extended. And so what happens to all that spending if the extension never happens? And it seems to go quite against some examples Inland Revenue itself gave in 2008 in a paper to guide companies. It gave several examples where this sort of spending, up until the point where the company's board decides to proceed with the project, that such feasibility spending should be deductible if it's in the normal course of business. Where it won't apply if you investigate setting up a business but you never set up the business, well, I mean, that's you can't deduct that against anything. But if you're already running a business and it's in the normal course of your operations, then it ought to be deductible according to this IRD paper. And that's what Mr. Griffiths is arguing, that, we thought the 2008 paper settled this question, but now the Court of Appeal's just thrown a very big curveball at it.
Sounds like a lot of corporate bean counters will be looking in the rear-view mirror, Jenny. That's NBR journalist Jenny Ruth.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio on Friday the 3rd of July. I'm Andrew Patterson, with me Hamish McNichol for our weekly court report. Hamish, let's start off with the Auckland gold trader and company director Robert Kairua, 53, sentenced in the Auckland District Court for pleading guilty and being convicted of numerous SFO charges.
Yeah, Kairua was the director of this company called Grace Holdings New Zealand Limited, which traded under the name Bullion Buyer. And in 2012, it went into liquidation, and at about the same time, the SFO launched an investigation into it. This case had gone quiet for a little while until NBR's Duncan Bridgman made a few inquiries last week, and then the SFO banged out a press release. But basically, he's being sentenced today. It was found that the company held investor funds of approximately $2.7 million, and he misappropriated about $370,000 of that. Basically, he pleaded guilty to 13 charges of theft and 9 of making false statements. He In his investment statements, or brochures, he'd said that he was more qualified than he actually was, what exactly the trading his company was doing was, and insurance and storage of the gold. So it's an interesting little case, and it's, like I say, it's gone quiet for a little while, but SFO's investigation began in 2012, so it's all coming to a fruition today.
Indeed. As we spoke about earlier in the week, a substantial foreign exchange dealer and currency remitter fighting back against Kiwibank's attempts to close its banking accounts and facilities. That's a decision that would probably end its business. This is all part of the Money Laundering Act.
Yeah, we spoke about this one fairly extensively on Wednesday. It's involving that company eTrans International Finance. Basically, Kiwibank has tried to shut down its account because it says it's too big a risk given those anti-money laundering regulations. We've had a little bit of feedback on this story. Lance Wiggs in particular, who comes on to NBR Radio from time to time, commented that the extension of the draconian AML regulations to money transferring has a chilling effect on business, and especially on inbound tourism and foreign students here. Some care is required. And I actually got a few emails yesterday as well from people with similar sorts of lines, basically saying it seems as though, while it seems that Kiwibank is flexing its muscles a bit here, it also seems like they're sort of stuck between a rock and a hard place, I suppose, and maybe it's the regulations that are at fault here rather than anything the bank is doing. So we're still some way from this being heard, and I've gone to the Bankers Association to see if they've got anything to say about it. These regulations have been controversial in the past, and as we noted on Wednesday, the Reserve Bank did tell banks in January that they need to chill out on closing all these accounts. Apparently 8 of the 15 foreign exchange dealers and remitters around Auckland have had their accounts closed. So yeah, like you say, the impacts on tourism and foreign students could be quite big. So a lot more to come on this one, I think. Yes,
indeed. And, of course, banks would be reluctant to close any account, assuming this is a business that, pays its fees and it gets it. So, but clearly the bank is obviously wanting to protect itself against the rules. And, of course, the penalties for breaches of this particular act are very significant. Let's talk, too, on Thursday, the Wellington accountant that's been suspended as a chartered accountant after going bankrupt, but continues to work in the industry despite an inability to manage his own finances. How bizarre is this?
Yeah, another one of these sort of local industry or industry body disciplinary tribunal decisions following the lawyer that was struck off on Tuesday. Basically, this guy Brian Hutton of Upper Hutt was last month suspended as a chartered accountant for the duration of his bankruptcy, so for 3 years. He was declared bankrupt in February. Though the tribunal did say that this was for reasons unrelated to accounting, and he wasn't actually working in accounting when he was adjudicated bankrupt. But he has since taken a job with a chartered accountancy firm. So while his chartered accountancy status itself has been suspended, he can still continue to work there, but he had sought name suppression and things like that. But basically, as the tribunal said, the fact that he's gone bankrupt himself maybe doesn't speak too well to his ability to manage the books of himself and perhaps others. So, it was just a funny little one, I thought.
Yes, not exactly expecting a queue of potential clients to be lining up outside of his office with a track record like that.
No, exactly.
Right. Thanks for joining us for our weekly court report. Hamish McNichol on NBR Radio.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
To Auckland house sales, and according to Barfoot and Thompson, the number of Auckland house sales were at the highest in 11 years for a June month, while falling from May as winter starts to slow activity. The city's biggest realtor said in a statement it sold 1,167 houses in June, down from 1,225 in May, though 13% more than the same month a year earlier. It said new listings were largely unchanged on the month at 1,749, though 52% more than a year earlier. And Barfoot had 2,959 houses on its books at the end of the month, down 3.3% from May and 9.6% from June 2014. Managing Director Peter Thompson said while the new government and Reserve Bank measures which are due to come into effect in October are likely to be having some impact on prices, as will the approach of winter, there is also a growing feeling among buyers and sellers that homes homes are close to being fully priced. June was the third month in a row when the number of properties for sale at month-end declined, and choice is now the most limited it's been since last Christmas-New Year. Quotable value figures this week showed New Zealand property values rose at their fastest pace in more than a year in June, with the Auckland shortage encouraging buyers to start scouting out the surrounding areas. The Auckland property market has been a concern for policymakers due to its supply imbalance, and the Reserve Bank plans to impose lending restrictions on property investors from October, while the government has tasked its tax collection agency to police capital gains more forcefully. Barfoot said the median sale price rose 4.8% to $786,000 in June from May, and was up 26% on an annual basis, while the mean sale price edged up 0.5% to $826,474 on a monthly basis, and was 16% higher on the year. In People News, a bankruptcy application against the developer of the $67 million St Luke's Garden Apartments has been withdrawn after liquidators reached a settlement on a $3.5 million claim for breaching directors' duties. Arthur Morgenstern was taken to court by liquidators of his former companies MSE, Kingdon Development and Axon House Car Parking. The case relates to the sale of 99 shares in St Luke's Garden Apartments to MSE, now known as Kingdon Undertaking, for $3.465 million. The purpose of the share sale was to enable the developer to repay his overdrawn current account. Work on the development stopped in 2006 after it ran into trouble during the second stage when it was incorrectly assumed the necessary resource consents had been obtained. The delays caused by the botch-up, according to an earlier High Court decision, significantly impacted the profitability. A liquidator's report showed it owed more than $15 million. In December, the Supreme Court dismissed an application by Mr Morgenstern for leave to appeal a Court of Appeal order for him to pay back the $3.5 million for breaching directors' duties. The liquidators, Grant Thornton, wanted Mr Morgenstern bankrupted, with an application heard in the High Court at Auckland on Wednesday. But today, the liquidators say the bankruptcy application has been withdrawn following settlement in respect of the breach, which will end the liquidation. Unsecured creditors are still owed about $950,000. In November, a judge ruled in favour of Meredith Connell after Bell Gully partner Murray Tingy, representing Mr Morgenstern, accused Meredith Connell partner Nick Malario of misleading Associate Judge Jeremy Doog in the High Court at Auckland. Mr Malario acted for the liquidators, but Mr Tingy attempted to thwart the proceedings by asking the judge to recall an order for substitute service on his client. An order for substitute service can be made when a person appears to be avoiding receiving legal documents. Market news. Pumpkin Patch, the Aileen children's clothing retailer, expects earnings next year will be significant below this year amid increasingly challenging international wholesale markets and adverse forecast currency impacts. The Auckland-based company affirmed expectations for normalised earnings before interest, tax, depreciation, etc. to be about $14 million in the year ending July 31st, in line with earnings a year earlier, which it said would lead to a modest after-tax loss. However, it said normalised EBITDA for the 2016 financial year would be significantly below that forecast for 2015. Analysts have been forecasting a pickup in 2016 EBITDA to $16.6 million from $14.4 in 2015, according to estimates compiled by Reuters. Pumpkin Patch shares dropped 12% to a record low 17 cents and have slumped 55% over the past year. The retailer has been forced to discount stock to maintain sales to compete with cheaper online rivals, shut unprofitable stores, and was tagged by its auditor last year over the prospect of breaching the terms of its banking covenants. Chairman Peter Scheidt said in a statement, although the earnings expectation for next year is disappointing, the company remains confident in the value and potential of the Pumpkin Patch brand and is committed to embarking on the change process necessary to deliver the results that stakeholders are expecting of the company. Pumpkin Patch named Luke Bunt as its new managing director, replacing Di Humphries, who resigned last month. Mr Bunt, who became a director of the company in October last year, was previously chief financial officer of discount retailer Warehouse Group. Mr Scheidt said Luke has made a significant contribution and has demonstrated the necessary skills and experience to address the complex challenges faced by the business at the present time. The company said directors Rod Duke, whose Briscoe Group is in the middle of a hostile takeover for Kathmandu, will leave the retailer's board, and Brent Impey will retire at the annual meeting in November. Separately, the company said it's in positive discussions with its bank over its existing banking facilities. It expects to have revised terms and conditions in place on July 31. Last month, Pumpkin Patch abandoned plans to refinance or find a buyer after interested parties didn't make a compelling enough offer for the board.
NBR. Need to hire? Try our online recruitment platform www.nbrtalent.co.nz.
To the dairy sector, Being Mate baby and child food company shares have halved in value on the Shenzhen Stock Exchange over the past 3 weeks, pushing their price 12% below what Fonterra paid for its 18.8% stake in the Chinese infant formula maker. Being Mate shares closed at 15.82 yuan yesterday, below the 18 yuan apiece, or 3.46 billion yuan, that the Auckland-based dairy company paid for 192.4 million shares in March. The shares have halved from a record 30.95 yuan on the Shenzhen exchange in mid-June, as the tech-heavy Chinese stock exchange abruptly pulled back after surging 100% since the start of the year. Fonterra and Being Mate announced their global partnership last August to help meet China's growing demand for infant formula and increase export volumes of Fonterra's Anmum infant formula brand. At the time, the world's largest dairy exporter had been hoping for a 20% stake in the company and flagged it would cost nearly $615 million. Last month, Fonterra sold its third dim sum bond, raising 1 billion yuan or $230 million, with the proceeds helping to fund the stake in Being Mate. The partnership will create a fully integrated global supply chain from the farm gate direct to China's consumers, using Fonterra's milk pools and manufacturing sites in New Zealand, Australia and Europe. The Chinese government last year imposed stricter regulations on products such as infant formula amid concerns over food safety. In February, Being Mate reported a 90% drop in operating profit in its preliminary results for the 2014 financial year to 65.7 million yuan compared to 721 million yuan the previous year. Revenue was also down by 17%. Units in Fonterra Shareholders Fund, which give holders access to the co-op's dividend stream, rose 0.2% to 489. The units touched a record low of 458 in mid-June after Fonterra posted a 16% drop in first-half profit to 183 million in the 6 months to January 31st, which it said reflected tough conditions in dairy, while also trimming its guidance for dividends to a range of between 20 to 30 cents and from a previous range of 25 to 35 cents. In crowdfunding news, PledgeMe has launched a second equity crowdfunding campaign to raise operational costs, but has reined in its forecasts after falling short of its 2015 estimates. The equity crowdfunding platform, which values itself at 2.1 million pre-funding, is aiming to raise between 250,000 and 750,000, or 10.3%, to 25.6% of the company. Last November, PledgeMe raised 100,000 through a crowdfunding campaign, giving investors a 14.3% stake in the business at $20 a share. The company used these proceeds to hire more staff and build a mobile-optimized website. PledgeMe Chief Executive Anna Gunther says the next lot of funding will be used to run more campaigns on the platform, hire new staff and expand the marketing budget. She says PledgeMe will be adding product extensions and improvements to make creating campaigns and pledging on them easier. It's also looking into establishing a secondary market, crowd lending, sector-specific subsites, and investigating a move into Australia, where securities laws are under review. Ms. Gunther says the first equity crowdfunding campaign sold out in less than a day, and there is a list of nearly 200 eager investors who've been waiting for the second campaign to go live. It did so this morning and has already attracted 51,660 of investment. Offer documents released for this funding round show PledgeMe failed to reach its 2015 forecasts. PledgeMe had forecast a net loss of 28,000 in the year to March 31st, 2015, but the current offer documents show it did not meet forecasts, instead making a net loss of 57,000. The company explains the missed target by saying projections are really a dark art and are rarely hit, with two crowdfunding campaigns falling on the wrong side of year-end by 10 days. It says, as we continue to scale up, we hope the impact of single deals will reduce, but this will continue to affect our projections over the next couple of years of growth. PledgeMe has also reined in its forecast for future years. At the time of the November capital raise, PledgeMe expected annual profit of 46,000 on revenue of 400,000 in 2016. It forecast profit to rise to 226,000 on revenue of 966,000 in 2017. But the current offer documents show the company now expects to remain unprofitable in 2016, with a forecasted net loss of just over $71,000 on revenue of $420,420. In 2017, the new forecasts show profit of just over $220,000 on revenue of $1.02 million.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
To the energy sector, the current oversupply of electricity generation is unlikely to continue forever, but market commentators are divided as to whether more storage capacity is needed. Earlier this week, Genesis announced that it retired a second coal and gas-fired Rankine unit at the Huntly Power Station. Chief Executive Albert Brantley justified this by saying that even with one of the driest periods in New Zealand in recent years occurring earlier this year, the stored unit had not been required by the wholesale electricity market. Mr. Brantley says, in our view, New Zealand electricity customers have a more than reliable supply of renewable and thermal generation. Supply growth over the past few years has been strong, while consumer and industrial demand growth has been relatively flat. But engineer Brian Leyland says reserve generation for dry years consists of 3 weeks of storage in the hydro power stations and the coal in Huntly stockpile. He said if the electricity market worked rationally, it would pay an annual sum to Genesis to maintain the stockpile and the capacity for thermal generation in a dry year. But the electricity market is run by academic economists, not power system engineers, so Genesis cannot afford to keep reserve capacity available for dry years. He said, while there is no doubt that we have surplus capacity at the moment, this will change one day, and once again, we'll be vulnerable to dry years with no backstop. Nikko Asset Management Senior Portfolio Manager James Lindsay agrees storage is a tricky option, which needs some thought, since there is such a large oversupply of generation at the moment. He says demand has been flat since the global financial crisis started, due in part to a soft economy, leading to industrial usage coming out of the market, and efficiencies such as insulation and heat pumps, combined with new geothermal baseload supply. Mr. Lindsay believes that if Genesis's 2 remaining Huntly-based Rankine units were needed again due to demand growth or permanent production outage, 3 months would be enough time to get coal on site again. He said demand growth equalising the market would be gradual, and so plenty of time to get the generation ready. However, if capacity came out of the market due to a station failure, then yes, the market would likely equalise a lot sooner. And for more on this, nbr.co.nz. In dairy news, Fonterra will be sentenced on August 3 after being found guilty over the stench it caused by discharging 3 million litres of buttermilk waste into the wastewater plant of the southern Taranaki town of Eltham in October 2013. It's understood that the South Taranaki District Council was fined $115,000 after it was found guilty of a comparable charge over its role in the incident. It's also understood that Fonterra has paid more than $500,000 in assisting the council clean up the waste caused by the dumping. According to a Fonterra spokesman, Fonterra takes its responsibilities under the Resource Management Act very seriously, and we do everything possible to ensure we meet best practice. The judge's decision was made a short time ago, and we're awaiting the written decision. We will review that before making any further decisions. To company result news, GE Finance and Insurance, part of General Electric's finance arm, which is selling down most of its assets worldwide, recorded a 10% fall in profit last year, reflecting a decline in finance income and rising costs. Most of the businesses of GE Capital, the finance unit of New York Stock Exchange-listed GE, are being sold as part of a strategy to shed some US $200 billion in finance assets and focus on industrial manufacturing such as jet engines and power turbines. In March, a consortium of Valda partners, KKR and Deutsche Bank agreed to buy GE Capital Australia and New Zealand's consumer lending business, including sales of finance, credit card, personal loans and general insurance for $8.2 billion Australian. That included GE Money, GE Credit Line, the GEM Visa card and the Countdown One Card Visa credit card. In April, GE said it would create a simpler, more valuable company by reducing the size of its finance businesses. Remaining assets targeted for disposal in GE Capital include real estate, commercial lending and leasing, and all consumer platforms, including US and international banking assets. Anthony Spargo, Comms and Public Affairs Director at GE Capital Australia and New Zealand, said GE Capital is currently selling all of its lending and leasing operations in New Zealand. GE will remain in New Zealand with a focus on its industrial businesses, similar to the global strategy. He declined to make further comment on the sales process or the 2014 financial performance of its local GE Finance and Insurance unit. The New Zealand finance business recorded a profit of $62.9 million in calendar 2014. down from $69.9 million a year earlier. Net finance income fell 6.5% to $177.6 million, as interest income from loans and finance leases declined. Non-finance income rose 4.4% to $212 million, led by a 6.7% gain in income from operating lease rentals. It has loans and receivables of $1.88 billion as at December 31st, down from $1.9 billion a year earlier.
NBR Radio. With Hotel de Brett, your home away from home, but with better service. NBR Radio.
To the Chinese slowdown, New Zealand businesses exporting to China can afford to be more relaxed about the Chinese economic slowdown, according to an analyst. Harbour Asset Management research analyst Owen Rimmer says he's not too worried about how the Chinese economic slowdown will affect New Zealand's economy. The Chinese slowdown issue slipped into the spotlight this week after the People's Bank of China, or PBOC, cut its benchmark interest rate for the fourth time in 6 months, bringing it down to the lowest level in a decade. The PBOC said the rate cut, which was slashed 25 basis points to 4.85%, was to further reduce financing costs for enterprises. As well as lowering its rates to a record low level, the People's Bank also reduced the amount of cash banks are required to keep in reserves. The lowering of the Reserve Requirement Ratio, or RRR, will step up support for the development of the real economy and promote structural adjustment, it says. The hope is the RRR cuts will spur lending within the People's Republic, stimulating more economic activity. This is the first time since the height of the GFC in 2008 China's central bank has slashed its interest rates and the RRR at the same time. Although the PBOC's latest monetary policy decision shows the Chinese economy continuing to slow, Mr. Rimmer says he's not convinced the slowdown in China will have an overwhelming effect on New Zealand's trade with the People's Republic. He said the slowdown in China is affecting the industrial and manufacturing parts of the economy and not so much the consumer demand side. As New Zealand doesn't export a lot of raw materials such as iron and zinc, which are used for manufacturing in China, Mr. Rimmer says New Zealand won't be hit too hard. ANZ FX strategist Sam Tuck expects the People's Bank to continue cutting its benchmark interest rates as the economy continues to slow. He says the bank had a bias to cut rates further but was reluctant to do so while the stock market was booming. Although the uncertainty over Greece's debt crisis earlier this week hammered the Chinese stock market, which fell by more than 7% last Friday, Mr. Tuck says the bank's rate cut was not a knee-jerk reaction to the market. The rate cut and targeted RRR cuts could have a one-stone, two-bird effect. Mr. Tuck says it allows the People's Bank to boost the sluggish economy while sending a policy signal that it does not want to see a market where share prices are continuing to fall either. In today's NBR print edition, property investment documents obtained under the Official Information Act show tax officials are more concerned about the extent of offshore buyers in the New Zealand market than the government has previously admitted. In litigation news, funder seeks level playing field. Homegrown litigation funder LPF Group tends to stay in the background but is a key driver behind several high-profile cases. That report from Jenny Ruth. To local government, rates rises and the council cost conundrum and fraud, tax refund sought on Ross Ponzi. Plus, New Zealand's rockstar economy is losing its swagger and foreign equity investors are beginning to hunt elsewhere, which may push share prices down, Calder Smiley reports. And controversial research on Crown lease tenure reviews has revealed some parcels of land freeholded and sold by the Crown for $11 million have later been sold for $303 million. Plus our NBR special report, it's all about SMEs. All this and more in today's National Business Review, out now. It's awards time. Illustrious New Zealanders gathered last night at an awards ceremony celebrating tall poppies, with former Prime Minister Helen Clark taking top honours. Ms Clark, who became the United Nations Development Programme Administrator after 28 years in Parliament, received the Supreme Award at Expatriate Association Kia's World Class New Zealand Awards. Others to receive awards were businesswoman philanthropist Audette Excel, tech entrepreneur Victoria Ransom, plastic surgeon Sui Tan, and former Olympian Beatrice Famawina. Malaysian businessman Tan Sri Halim Saad received a Friend of New Zealand award for his work building relationships between New Zealand and Malaysia. Sydney-based Kiwi Audette Excel has used her financial services background to create an effective charity for maternal infant child health, trafficked children, and remote health and education services in the developing world. The former managing director of Bermuda Commercial Bank and chairwoman of the Bermuda Stock Exchange founded the Adara Group. This generates funds through a private placement and corporate advisory business for the non-profit foundation to use. Tech entrepreneur and NBR Rich Lister Victoria Ransom is well featured in the tech pages, having sold her company Wildfire to Google in May 2012 for a reported $250 million US, plus a US $100 million staff retention bonus. Manawatu-born Ms. Ransom remains working for Google and is based in San Francisco. World champion discus thrower Beatrice Famawina has become a successful businesswoman since retiring from the sport in October 2011. She was the founding chief executive of Best Pacifica Leadership Academy and Charitable Foundation and is now ASB Talent and People Strategy Head. Ms. Famawina is also a United Nations Goodwill Ambassador. Internationally recognised Kiwi plastic surgeon Sui Tan was born to plantation work appearance in Malaysia and is now plastic and cranio-maxillofacial consultant surgeon at Hutt Hospital and executive director of the Gillies Mackindale Research Institute. He's especially well known for making breakthroughs in the treatment of birthmarks. Kia Global Chairman Phil Veal says the award showcased New Zealanders' best achievements throughout the world. He says making the most of the connection to these talented people is good for New Zealand's economy and society. Each winner received a statuette of a tall poppy designed by Weta Workshop co-founder and 2009 Supreme Award winner Sir Richard Taylor.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
NBR Radio on Friday the 3rd of July. I'm Andrew Patterson. Time for our weekly macroeconomic roundup, and joining me Jason Walls. Jason, let's start with the big story of the week. Greece. Take us through a week of pretty volatile action.
Pretty volatile is absolutely right. It's been a crazy week in Europe and especially in Greece. I'll start from, let's say, about this time last week, because you can actually break a situation like this down by the day. And I think, what day is it? It'd be Friday today. So what we were seeing last week is we were leading up into Tuesday. And Tuesday in Europe was the cutoff date for when the debt was due. So we were seeing Tsipras and his government still trying to implement reforms. So from there, they were all rejected. And then the reforms that the creditors were proposed to Greece, they just said, no, this is not good enough. And this forced a lot of volatility. We saw on Monday that stock markets around the world went haywire, essentially, and it was just madness, especially in China. And that's something else that I'll come to in a few minutes. And then Mr. Tsipras announced on Sunday that he was going to have a referendum for the debt and the austerity measures. So essentially what he said was that he was going to ask the Greek people if they wanted to adopt the austerity measures. And since then it's been extremely split on whether people are going to accept or people are going to say, oh, well, the vote is yes or no. Should we accept the creditors' offers? And some saying yes, some saying no. So it's not clear which side is ahead at the moment. Fast forward to Tuesday, no surprises. Greece defaulted on the debt. They didn't have any cash to pay the IMF, which means that the $16 billion, or euros, that the IMF had in reserve for Greece have been cut off, and they have just no way to pay any of the other debt. It's also worth pointing out that they've got a lot of pensions to pay, and they've got a lot of public sector wages as well. So it's a really dire situation from Greece. Right now, we're sort of in limbo as we wait for the referendum on Sunday. All creditors have stopped negotiations for Greece and said, we're not going to have any more conversations until the outcome of this referendum, which they're urging the Greek people to vote yes, please accept our credit, our austerity reforms. However, the Greek government is urging them to vote no. So it's a really, really bizarre situation.
And then this bizarre sort of capitulation on Wednesday night where Tsipras basically said after the fact, well, maybe we will just accept the bailout terms with only fairly minor modification.
Yeah, he's done this before. He's said, okay, we'll accept them if you do this and this and this. And then they've said, okay. And they've made modifications, but he hasn't seen them in line to what he is wanting. So, I mean, he said a lot of things. And he said on Greek television, he was outlining that it was like, doesn't matter what happens on Sunday, we're still going to be part of the Eurozone, which is, it's a lot more to come.
All right, so we watch for the result of Sunday's referendum. And of course, what's been overshadowing all of this is some quite big economic moves out of China. What happened this week?
Well, we saw over the weekend that China again dropped their interest rate, and that is for the fourth time in 6 months. So that's a huge easing bias. So they were on, I can't remember what it was, but it was quite high in December, and then that dropped and dropped and dropped, and now it's at a 4.85 level. So you compare that with New Zealand, and we're at 3.25, and it seems a huge amount above us, but I mean, they had rates. I mean, it's just been at a high level for ages, and they've been dropping it. So this points to a lot more stimulus within the Chinese market. We've documented well here on NBR Radio the Chinese slowdown, and in fact, at the beginning of the year, the GDP growth only grew 7%, which, again, if we look at it from New Zealand's point of view, that's huge, but for China, it's a lot less, and it's actually quite concerning for them. So they've been looking to add stimulus into the economy any way they can. They've cut taxes on some commodity goods. They've reduced rates, as I've said, and today, in the same announcement, they actually reduced the reserve requirement ratio for banks, which limits the amount of cash that they have to have in reserve. So the idea behind this is it spurs lending, as banks have to have less in so they can... Economics, complicated stuff, but it spurs lending. And it's the first time that China have actually cut rates and the reserve requirement ratio together since the global financial crisis in 2008. So that's quite a big red flag if you're looking at the country's growth, that they're looking to inject this much stimulus into the economy. And I'm currently writing up a story, which you can read on NBR online at the moment, about how this is going to affect New Zealand. We've talked before that the slowdown like this is probably going to have a bigger impact on Australia, because the Chinese are looking to kind of soften their demand for raw materials such as iron ore and things like that, where Australia produces quite a lot. However, New Zealand, most of what we export to China is dairy and meat and things like that. And although there might be a softening of demand, it's nowhere near going to be as bad as it will be for Australia.
And finally, let's talk about a country that doesn't often appear in the headlines, and if it weren't for the week that was dominated by Greece and to a lesser extent China, this would have been the big business story of the week. Talking about Puerto Rico, some quite significant developments. I mean, it's actually talking about a repayment amount substantially more than Greece owes, which it's basically said it can't afford to pay.
Yeah, well, and as you quite rightly pointed out, it's been really overshadowed this week by the developments in Greece and in China. And I would have usually led with a story like this on the wrap up, but it's huge, $70 billion in debt that they have to repay, and the governor has essentially said that they can't do it, and they've been put in, his really interesting quote, a death spiral, which is, I mean, a governor is to use language like this, it must be really dire. And it's worth pointing out that the country has just 3.6 million people. So it's smaller than the size of New Zealand, but it's got this huge debt that just can't pay back. And most of the debt is owned by the US investors in things like mutual funds. So that means that a lot of the debt that's in there isn't even known, that the people that have the debt in there don't even know that it's there, because they just kind of give their money off to these sort of funds. And
Puerto Rico is a protectorate of the United States, I think.
Yeah. So that's why there's been a lot of chat around how this is going to affect the US as well. But yeah, it's the government couldn't keep borrowing money to address the budget deficit. So it can't ask residents who are already struggling with things like high rates of poverty and crime to shoulder more tax on this, because, it'll place more burden on the economy. If you raise taxes, that means there's less spending, and it could be ultimately worse. So this will be another one to watch, and to see how the IMF and other people, because they've asked for an emergency bailout fund, will react to something like this. Because the interesting thing is here, because you've seen Greece get all this attention and all this money from some of its creditors, but that's because it's in the Eurozone, and most people agree that they just don't want Europe to falter. If it was Greece by itself, it'd be a different story. And now we see a country which is by itself, which isn't attached to a union such as the Eurozone. It's going to be a very different story, and see how this plays out. It's going to be interesting.
One assumes we don't expect the US Federal Reserve to ride to the rescue of Puerto Rico.
No, I think they've got their hands full with the rate hikes coming up soon, which is, that's another interesting thing that's coming up in September, and we'll be talking a lot about that as well.
All right, thanks for joining us. Jason Walls on NBR Radio.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
To the electricity sector, Mighty River Power's Metrics metering business has walked away from a deal with Infratil-controlled Trust Power that would have supplied the power company's 242,000 electricity customers with smart meters. The Auckland-based company decided not to proceed with the contract after reviewing the system's development to date and continuing requirements, it said in a statement. The contract had been expected to start this year before scaling up in 2016. Mighty River Power said it will divert the 3-year $100 million capital expenditure program into its capital management. Metrics Chief Executive Matthew Auld said while it's very disappointing to end the agreement before commencing services, it has recently become clear that continuing could potentially impact Metrics' core business in the short term, and the contract was not sustainable over the long term. The evolving and unforeseen complexities involved in the system's development and integration and associated delays have been key in reaching this decision. The government-controlled power company has been chasing growth through its Metrics service, which provides electricity retailers and companies with smart meters and is the second largest provider in New Zealand. The smart meter business had installed 377,000 meters as at June 30. MRP shares last traded at $2.88. Size matters after all. The challenges for attracting foreign investment to New Zealand aren't strictly regulatory. The problem is the lack of sizable investment opportunities, according to an investment fund manager. Despite some positive signals in a recent study by the US-based Milken Institute, which found New Zealand ranks 4th in the world on its Global Opportunity Index, New Zealand simply can't offer the size of investments needed to attract middle-range or larger offshore funds. This dynamic is proving to be a major barrier to investing in New Zealand, and to appeal to overseas investors, there has to be a much larger carrot than currently on offer. Sean Hennigan of AMP Capital, a Kiwi expat and head of multi-asset in Australia, told the NBR the Milken Institute's index shows New Zealand is growing in attractiveness, but to invest directly into New Zealand is problematic for a whole host of reasons. Mr. Hennigan is responsible for a multi-asset group of totalling between 75 and 80 billion Australian dollars. This means a minimum investment ticket size for his fund to be interested must fall between 35 to 50 million. Often, however, the smallest investment his fund will make is 500 million, which places a lot of New Zealand's assets far too low. Another problem is that in Australia especially, investment funds are growing and have a tendency to prefer fewer and deeper relationships with investment opportunities. Few managers want to be monitoring 150 or 200 smaller investments. Many simply don't have the personnel for that, but this means the minimum ticket size eventually gets bigger. Mr. Hennigan says, I'm responsible for a large diversified fund of about 12 billion Australian. I manufacture that fund to a fee budget of 21 basis points. There's some context on what I can afford to spend. The two investments AMP Capital presently has in New Zealand is an 88 million investment in a power company and 700,000 in Auckland hospital car parks. Both were a result of a mandate given to our infrastructure team to invest wherever they find opportunities in New Zealand. He says there has proven to be a number of opportunities in New Zealand, but the interesting point is that 65% of foreign direct investment comes from Australia, and it's generally in smaller quantities. For more on this story, nbr.co.nz.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland. Rest home operator Arvida shouldn't have done a discounted placement to outside investors so soon after its December float, according to Kapiti Coast financial advisor Chris Lee. With more on that story, I'm joined by NBR journalist Jenny Ruth.
Well, Mr. Lee's picked up on a capital raising that I completely missed, but I have to say I agree with his views. Arvida decided to raise most of the money via a placement to institutions, and it's already raised $30 million. Now, that placement was underwritten, and it was priced at 84 cents a share. Well, the float in December last year, the shares were sold at 95 cents. So it's dilutionary of existing shareholders. They can participate in a share purchase plan, but there's only $5 million worth of shares being offered in that plan, and it's capped at a maximum of $15,000 worth of shares per shareholder.
So Mr. Lee says he wonders if the Shareholders Association has a view on it. Do they?
They definitely do. John Hawkins, the chairman of the Shareholders Association, has pointed out many times that especially now that the rules around renounceable rights issues have changed, where you're issuing shares of the same class, new shares of the same class, you don't have to produce all the costly documentation that used to be required. And it's relatively straightforward to do a renounceable rights issue. You only need to look at Kiwi Property. They did a capital raising via rights issue. And the Shareholders Association argues that a rights issue treats all shareholders equally, and all shareholders have an equal chance to participate, whereas a placement and a share purchase plan just simply, you're not treating all shareholders equally. Wynyard Group, or another company that recently chose to do a placement and share purchase plan, it kind of surprises me what the Shareholders Association is saying is so patently arguing on the side of fairness. It surprises me that companies aren't paying more attention.
Now, you say Mr. Lee's criticisms of Arvida go much wider than just this capital raising.
Yes. Well, it's billed itself as a retirement village operator, and we've already got 3 retirement village operators listed. Ryman, which is one of our best quality companies, MetLife Care, and Somerset. Now, there's a big difference between those companies and Arvida. 54% of Arvida's facilities, when it floated, and 84% of its care revenue was devoted to. 54% of its facilities were care beds, and that meant 84% of its care revenue was coming from the government. That's much, much higher than the other operators. I think Ryman's the next highest, and I don't think theirs is much over 34%.
So I guess the bottom line in this is that Arvida might expect a bit more scrutiny from its shareholders at its next AGM.
Yes, I should just say on the reason that it's important that its business is different is the companies like Ryman are making their profits on the property side of the business. If you're supplying services that are largely government funded, and the entire industry agrees that government funding is inadequate, you're definitely hard pushed to make a profit. And we saw another company that had a preponderance of exposure to the care side of the continuum, Elder Care, which was owned by Abano Healthcare. That was listed for a few years, and Abano eventually sold it in 2006 and commented that they just couldn't make it pay.
Excellent insights as always, Jenny. That's NBR journalist Jenny Ruth.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
In market news, well, kind of. 3 upbeat announcements sent to media within 4 days, but no sign of notice to the NZX seems a slightly odd strategy for a company on a quest for growth and popularity. But this is just what Diligent Board Member Services has done. The board governance software company issued press releases on June 29, June 30 and July 2. And while not price-sensitive, the appointment of senior management staff and customer number milestones are generally updates the market likes to know. NBR spoke to New York-based Chief Executive Brian Stafford about the company's publicity strategy. He says it's a fine balance between putting not enough news up on the NZX and too much. He said anything material from a stock perspective will be put up there, but these announcements were deemed by us to not be material. Everything's up on our website. He says, but we will start putting more up on the NZX. We're in the process of deciding how much news should be put up on the NZX and how much through press releases and on our website. We're evaluating what's the right amount of content. It's organic, he says. If our investors want more put on the NZX or less, we'll adjust accordingly. Diligent has announced it's boosted its Europe, the Middle East and Africa client numbers, with 500 organisations now using its Diligent Board's product, which is now available in Spanish, French, German and Portuguese, as well as English. Diligent's clients represent over 56% of the AEX 25 in the Netherlands, 13% of the DAX 30 in Germany, 15% of the CAC 40 in France, and 20 organisations listed on the Johannesburg Stock Exchange. The company hired more EMEA strategic sales and account management staff and opened local offices in Switzerland, Spain and France. The company said earlier this year revenue for the EMEA region increased by 45% in 2014. The company announced yesterday that it had appointed 2 new senior management staff. Jeff Hilk, who's been at the company for more than 4 years, was promoted to Chief Customer Officer, and Sean Langton was appointed Chief Marketing Officer. Mr. Langton was previously Associate Partner at McKinsey & Company, where Mr. Stafford also came over from. Mr. Stafford said, where we think it will push things forward, we'll add more leadership capacity to the team. We're building momentum internally. It's an exciting time and there's a lot of opportunities for growth. The company also reports it won the Customer Service Team of the Year in the annual American Business Awards. The 3rd year in a row it has won an award in this category. The company, which will launch new product diligent teams in the 3rd quarter of this year, has a client retention rate of 99%. Let's look at trading activity. The volume and value of trading on New Zealand Stock Exchange increased last month, led by a gain in smaller value trades. The total number of trades rose 32% to 139,527 in June from the same month a year earlier, as value increased 9.4% to 3.2 billion, according to the NZX in its monthly shareholder metrics. Daily average trades increased 25% to 6,644, while the value of trades below 50,000 climbed 32% to 130,558. The number of equity trades increased 33% to 136,779, while value increased 8.9% to 3.1 billion. In the debt market, the number of trades slipped 1.1% to 2,748, while the value traded increased 27% to 106 million. The value of NZX's equity market climbed 13% to 102 billion, or 42.1% of GDP. The number of listed equity securities increased 2.4% to 172 from the year earlier. Last month also marked the launch of NZX's NXT market for small to medium-sized enterprises, which kicked off with mail service company G3 Group joining the bourse in a compliance listing. The value of NZX's debt market slipped 2.4% to 13.2 billion, or 5.5% of GDP. The number of listed debt securities fell 7.1% to 79 from the year earlier. Shares of NZX last traded at 108 and have fallen 13% over the past 52 weeks. Market news. Disgruntled Alliance Group shareholders say they hope to have the support from 5% of their number within the next 10 days that's required to force a special meeting to discuss the potential benefits and risks of a merger with Silver Fern Farms. Last week, Silver Fern Farms shareholders crossed the 5% threshold to force a special meeting of their meat cooperative to vote on seeking a full analysis of the benefits and risks of merging with Alliance, along with a comprehensive risk mitigation plan verified by an independent firm. Gay Cowie, a rural accountant and farmer who, along with Balfour farmer Jeff Cowie, pushed for the Alliance special meeting, said they've had good feedback from other shareholders in the past few days since launching their campaign. She wants to attract support from 5% of shareholders, or 3.5 million shares, within the next 10 days to 2 weeks, the same period it took to force the Silver Fern Farms meeting. Ms Cowie said if it doesn't stack up, it doesn't, but as shareholders we need to understand why. Farmers are ready for a change because it's not looking very good for the future of the sheep meat industry. Our generation has to improve things for the next generation. Alliance has consistently said it can't see benefit in merging with the debt-laden SFF, as at the end of last year, SFF's debt had been cut to $288.6 million from $387.6 million the previous year, and it's currently trying to raise $100 million of new capital. Meat Industry Reform Group Meat Industry Excellence, or MIE, is still pushing its plan for a new export meat co-op that would park the debts of the two big farmer-owned cooperatives into a bad bank. The good equity would be put into a good bank, and the two co-ops merged into a new company. Ms Cowie said the meat companies can't afford to stay stuck in the past and wants the Alliance board to state its long-term strategy to shareholders and give them the opportunity to show support for an independent assessment of the business case for amalgamation. Any votes made at either special meeting won't be binding on the meat companies' boards, but Ms Cowie said they need to listen to what shareholders want. A date is yet to be set for Silver Fern Farms special meeting, and the company said today that the meeting won't have any more information available to consider analysis or risk mitigation of the proposed merger. It said in a statement, Only if the resolution is passed at the meeting and if the board elects to act on it would the board then undertake and provide the further analysis sought, subject to the normal bounds of commercial confidentiality. It also rejected claims by Otago farmer Alan Richardson, who gathered the required votes for the meeting, that the board hadn't yet investigated the potential gains of $100 million a year tabled in MIE's March report on industry restructure. It said the company has reviewed in detail and done so a number of times the costs and benefits of industry consolidation, including those related to a potential merger with Alliance. A merger requires the willing participation of all affected parties. The company said while the costs and benefits of potential rationalisation opportunities can and have been estimated, if the opportunities remain unconsummated, then the analysis is moot.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
This is NBR Radio on Friday, July 3rd. I'm Owen Poland, and welcome to the political and economic week that was with Rob Hosking. And Rob, kicking off with politics, the big talking point this week, the selection of a deputy leader for New Zealand First.
Yeah, the election they refused to tell us about. It was all very strange. There was the rumour swept Parliament on Wednesday that the New Zealand First had perhaps elected a new deputy leader, but if they were, they'd decided to keep it very quiet. And it was all very, and not even comment on it. It was all very strange, and it certainly got the attention. But frankly, even when they elect a pope, they send up smoke signals, and there weren't even many of that from New Zealand First, even though Winston Peters, as is known, can puff away like a chimney at times. It was all very silly. But anyway, this morning we finally had confirmed what the rumour mill had been telling us for 48 hours, which is that Tracy Martin, who has been the deputy leader of New Zealand First, didn't get re-elected, and the new deputy is Ron Mark, who came back into Parliament at the last election. He was a New Zealand First MP back in the 90s and through till they lost their seats in 2008. And since then, of course, he got elected MP for Carterton.
Winston Peters must know more than anybody else that the less you tell the media, the more they want to know. Was this just a ploy on his part to attract attention to the issue?
Oh, it probably was. Look, fathoming what motivates all this sort of fairly childish, frankly, carry on, I don't know anymore. and there's a small part of me that just doesn't care. Look, but that said, there's a bigger sort of game afoot here, and it's not just about New Zealand First. Winston Peters turned 70 back in April, and he's probably got one more election in him. There are constant rumours, of course, that he won't even fight 2017. He's now got an electorate to look after.
He'll be exhausted after that, yeah.
Yeah, and there is the perennial rumour that Shane Jones will be parachuted in to stand for that electorate in 2017. Of course, Shane Jones is also a native Northlander. Look, again, that is something that I keep hearing. The Shane Jones ploy has become such a perennial rumour that no one can trace it. And it's personally, I'm quite suspicious of these sort of insider bits of received wisdom because they tend to just be repeated and repeated and repeated, and no one actually checks them out. And whenever you do check this out, you hit a blank wall. So it may happen, it may not. I have my doubts because I think Shane Jones is also starting to get to a point in his life where we would rather not have the huge workload of running an electorate seat and leading a political party. You've really got to have your wits about you there. And also, if he gets parachuted in, then and this brings us back to the deputy leadership race we've just had, there's going to be a lot of people, two in particular, who are going to be existing New Zealand First MPs who are not really very happy about that. So I just can't see how that scenario can play out. The other part of the wider thing, of course, is the Conservative Party implosion in the last fortnight, and a lot of that is about pitching for the post-Winston vote. Really, the opposition parties, and I'll include Labour here, are starting to look a lot more closely at what a post-Winston Parliament might look like. And because Winston Peters, although, if you're going to look for major policy contributions to New Zealand public life, you spend a long time looking once you get past the gold card. There just isn't a lot there. There's been a heck of a lot of sound and fury signifying very little for the 30-odd years he's been, more than that, he's been in politics.
Sure.
But he's been a real weathermaker, and we're going to, at some point in the next 3 or 6 years, going to have to learn to get along without Winston. And that is actually going to change the dynamic of our politics quite a bit.
Moving on, I understand the government's been firming up its property tax proposal.
Well, this is the stuff that was announced in the budget, and we have a piece in print in the print edition this morning where we got hold of some briefings within the Inland Revenue before these things were announced. There's two things that stand out. This is the Bright Line test and the de facto register of foreign investors. The Bright Line test is the thing that basically says if you're buying and selling property within 2 years, it's going to be deemed part of your, the capital gain will be deemed as part of your income, and you'll be taxed on that, regardless of, whatever. It's just, that's the way it is. Boom. That means there's a couple of things there, and I'll look at that Bright Line thing first. The first part about that 2-year test is, and there was some criticism that, look, it's only 2 years. Treasury wanted 5 years. But even so, what that does is takes that 2-year buying and selling period out of the area where the IRD has to try and prove that you intended to sell it for a capital gain. It's just deemed that way by law now. So the enforcement activity, and they've got more money to spend on that enforcement activity as well in the budget, doesn't have to go to that stuff. It now will move up to the longer held bits of property, and they're going to be able to put a lot more audit activity into the 2-year thing takes care of the low-hanging fruit. They'll be able to focus a lot more of that audit activity on the high-hanging fruit that they might have had to leave alone in the past. So that's going to make a difference to the whole dynamic of property investment and the tax issues around that. The more important thing is that is the impact of foreign investors in the market, and this has long been a subject of rumour and innuendo and often some quite racist comment. What I found interesting about the briefings, which haven't been released anywhere else, that I got hold of, is that IRD has been saying we think there's a lot bigger impact of foreign investors than we thought, and quite a bit of that impact is masked. It has been happening under the radar. There's been a lot of stuff going on that we just don't know about, and then now, because the new rules basically say if you're an offshore buyer, you've got to register the ID, you've got to have a New Zealand bank account, and basically you pay withholding tax up front, and you've then got to make a case to have that back as a tax deduction. And I would imagine quite a few won't bother to do that. So this is shaping up to be a bigger deal, particularly on the foreign tax, on the foreign investor side, than perhaps it looked like 2 or 3 months ago, 3 to 6 weeks ago.
You're listening to the political and economic week that was with Rob Hosking, and turning to economics, Rob, the Kiwi dollar just keeps on plumbing new depths.
Yes, headed below 67 cents US on that particular cross rate. The other thing is that on a trade-weighted index basis, which is that's the basket of currencies of our trading partners, it is, as of last night, it's 6% below what the Reserve Bank thought it would be for as an average for the entire current quarter. Now, that's not minor. And what that means, amongst other things, is that although obviously that is going to help our exporters a lot, and that's long awaited. We've been told for 2 years, 2.5 years now that, and we've been told correctly that our exchange rate is overvalued and unsustainably so. It is now heading back down again. But what that is also going to do is push up the cost of imports. And if that feeds through into bigger price inflation than was expected by the Reserve Bank when it started cutting interest rates a month ago, then you've got a bit of a different dynamic happening here as far as how far the Reserve Bank is going to be able to go with those interest rate cuts. And I know the overnight index swap market's priced in, well, certainly going to be one more cut, and it's probably going to be at the end of this month instead of in September, which is what it looked like earlier. But how far they're going to be able to go beyond that is going to depend on two things. One is how far the dollar falls and whether that starts fueling inflation. And the other thing is if growth starts coming off rapidly, then yes, they're going to be able to cut interest rates more, but we actually don't want that to happen, obviously. And we're getting economic policy, there's a lot of different balls in the air at the same time. But what it's starting to look like is, and we'll have a better picture for the outlook probably at the end of next week, because there's two big forward indicators coming out next week. But if growth starts looking like coming off really quite substantially, then yes, they'll have room to cut. But obviously we don't want growth to come off that substantially. And that's going to be a function of how far the commodity prices, well, milk, dairy price continues to fall, how far non-milk commodities hold up, and meat has been doing reasonably well. Tourism has been doing quite well the last season, and the dollar will help tourism. So, there's a lot of different things in the mix here, but I think people are expecting that the Reserve Bank is going to keep cutting. I wouldn't take that for granted just yet because of that inflationary pressure that is going to be coming through on the other side.
And that's the political and economic week that was with Rob Hosking.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
To the banking industry, the New Zealand Bankers Association says banks are closing the accounts of money remittance businesses because of money laundering risks and the significant cost of legally monitoring them. Last week, a substantial foreign exchange dealer and currency remitter won an order from the High Court prohibiting Kiwibank from closing its accounts and facilities until further order from the court. A substantive hearing claiming breach of contract has been given priority, given it's likely of interest to all banks, but is not expected to be heard until next year. In March, Kiwibank told eTrans International Finance, established in 2003, that it was closing the company's accounts because it considered the business posed too great a risk to the bank under the Anti-Money Laundering and Countering Financing of Terrorism Act. eTrans has banked with Kiwibank since 2004. Its sole director and shareholder, Xiaohua Sun, says all the major trading banks are taking similar action and other accounts held by eTrans with other banks have been closed. Mr. Sun says 8 of the 15 specialist money remittance and currency exchange providers trading in Auckland have had their accounts closed. New Zealand Bankers Association Chief Executive Kirk Hope says banks take their obligations in meeting the anti-money laundering law very seriously. He says, but one of the consequences of doing so has been the account closure of some money remittance businesses. Mr. Hope says the banks have invested heavily in policies, systems, processes and staff training to ensure they identify, manage and mitigate any risks which the law targets. He said there's obviously been significant cost associated with this investment. The Reserve Bank told the country's banks in January this year the legislation does not require them to take a broad brush approach against money remitters after some expressed concern banks were indiscriminately terminating their accounts. Mr. Hope says it backs the Reserve Bank's stance, believing banks have applied their obligations on a case-by-case basis. Banks operate in a very competitive environment to attract and retain customers, but this is balanced by the need to take compliance obligations seriously. Mr. Hope says if they can continue to bank a customer within the bounds of their AML obligations, they will. To Trustpower and tax. EY tax partner Dave Griffiths says last month's Court of Appeal decision against Trustpower in its dispute with Inland Revenue is an ugly result for the company, but also has very worrying implications for a wide range of companies. The court ruled that $17.7 million of spending on feasibility studies, including resource consent applications, can't be treated as business expenses and immediately deducted for tax purposes. Instead, such spending should be treated as capital spending and depreciated against the eventual asset. Mr. Griffiths says the problem with that is there may never be an asset to depreciate if Trustpower and other companies engaged in similar exercises decide not to proceed with the project. He says the Court of Appeal has thus created more black hole expenditure. The government, he says, has been trying to close up situations where there's black hole expenditure, and now the courts have gone and created a new black hole. Mr. Griffiths says the decision also goes against the IRD's view on how to treat the costs of feasibility studies published in a 2008 guideline. Essentially, that guideline said companies undertaking feasibility studies directly related to their existing business can expense the costs up to the point at which they decide to proceed with the project. Although the IRD argued in the Transpower case that a resource consent is of itself a capital asset, the earlier High Court decision in Trustpower's favour ruled consents are just part of the feasibility process. Mr Griffiths says that with the kind of massive projects such as those involved in the Trustpower case, it's common for companies to apply for and gain resource consent before they've made a decision to proceed. For one thing, he says, you don't know what the terms of the resource consent are going to be and whether that's going to work for you. To the US economy, the latest job figures from the US reveals 223,000 jobs were added last month, resulting in the lowest level of unemployment in 7 years. But the labour force participation rate, which measures the number of people who are either employed or who are actively looking for work, dropped to 62.6%, which is an almost 40-year low. By comparison, New Zealand's participation rate is close to 70%. Westpac senior market strategist Imre Speiser says that although the data was a bit weaker than expected, some analysts were forecasting closer to 235,000 new jobs. It certainly wasn't bad enough to dissuade any analysts from changing their call for a September hike to something later. The US Federal Reserve did not raise its interest rates this month, which was no surprise to the market, but Fed Chairwoman Janet Yellen has hinted the long-awaited rate hike could come in September. She says no decision has been made by the committee about the right timing of an increase, but certainly an increase this year is possible. The job data will be welcome news for Ms Yellen because she has iterated in the past how rates will be hiked when employment numbers were looking more favourable. Although the chairwoman and her Fed Reserve colleagues are optimistic the US economy will be ready for a rate hike, the IMF has warned the Fed to hold fire until next year. IMF boss Christine Lagarde says rates should be kept at zero until at least the first half of 2016, despite acknowledging the underpinnings for continued expansion in the US is still in place. CMC market analyst Sheldon Slaber says that although the headline employment number looks good, when the surface is scratched, it loses its shine. The figures show wage growth is stagnant, with average hourly earnings rising just 2% over the past 12 months, with the average US worker making $24.95 an hour in June. Mr Slaber takes a more dovish stance to the data and says it's a blow for Ms Yellen's planned rate hikes. On May 22nd, Ms Yellen said she would raise rates based on a 5% unemployment forecast and some other data. Mr Slabbert says currently at 5.3%, and with a worsening participation rate, she's not there yet, and it's now more likely that the Fed will raise rates in September.
NBR Radio. Free to air online with business news you can use.
In market news, 2 directors of Marlborough Lines resigned from the board a fortnight before the announcement of an $89 million investment by the company in Newlands Wine Group. The deal has raised questions in the minds of investors, business leaders and community groups, some of whom have contacted NBR. Directors Anthony Beverley and James Hay both resigned from Marlborough Lines on June 22. Mr Beverley says it's inappropriate to comment. He's also a director of NZX-listed PFI and formerly a director at AMP Capital Partners. Mr Hay could not be contacted as yet. He's operations manager at Central Plains Water Irrigation Company. Marlborough Lines Managing Director Ken Forrest says he can't comment on the departures. People resign for their own personal reasons, he says. Questions posed by NBR sources concern any debt associated with the 80% investment in the wine company and the appropriateness of such an investment for the lines company owned by the community via Marlborough Electric Power Trust. Mr Forrest emphasises the investment was made on a cash, debt-free basis from the proceeds of recent investment sales in the Bay of Plenty Electricity Company in May and last year's sale of its half-share in Otago Net joint venture. Mr Forrest says there are regulatory constraints on the allowable returns of electricity lines companies coming into effect this year with a maximum of 7.1%, and therefore an investment outside the sector offers best prospects. Other electricity lines companies around the country have made similar kinds of investments, he says. The sale process was managed by UBS and was deemed worthwhile by the Marlborough Lines board. The Community Trust has ratified the deal. Some commentators have also queried the expertise of Marlborough Lines investing in a wine company. Whether the management of Marlborough Lines has familiarity with the wine sector remains unclear. But directors of Marlborough Lines have more than passing familiarity with wineries, and at least one director of Newlands has expertise in the lines company. Marlborough Line's chairman, David Dew, has been involved with several wine sector companies, including one called River Farm. It was placed in liquidation at the behest of its shareholders in 2012, with $2.2 million returned to secured creditors, including BNZ from the sale of properties, but leaving unsecured creditors out of pocket, according to the liquidator's last report in mid-2014. Mr. Dew was one of the drivers of Marlborough Line's controversial bid to take over Horizon Energy in the Bay of Plenty a few years ago and sold recently. The Lines Group retains a half share in Nelson Electricity. Mr. Dew has also been a fellow shareholder with a Yealands director, Peter Radich, in a company called London Radich Dew Company, which was struck off for reasons not made available in company's office records. Mr. Radich, a well-known local lawyer, was also once a director of Marlborough Lines and resigned in 2002, according to company's office records. The deal represents an excellent succession plan for Yealands founder Peter Yealands, who says he has other projects he would like to undertake. Let's talk New Zealand and Europe. DLA Piper partner Sue Brown says New Zealanders doing business in the Eurozone should be taking steps now to minimise any impact should Greece and perhaps other countries exit the Euro. Ms. Brown says, I'm not saying it's all desperado, I'm saying watch this because it could turn nasty. Companies need to know now where they stand with contractual arrangements rather than waiting for a crisis to erupt, she says. New Zealand's trade in goods and services with the European Union is far from trivial. Stats New Zealand figures show exports in the year ended March stood at $8.1 billion, with services accounting for $3.2 billion of that. Imports in the same period totaled $11.5 billion, with services accounting for $2.9 billion. While New Zealand sends a lot of agricultural produce to Europe, it imports things such as trains from Spain, aircraft from France, goods vehicles from Austria, and transport vessels from Italy. The two-way trade and services includes travel, education, and transportation services, while financial services account for $146 million of exports. Ms. Brown says firms should take stock of the extent of their business in Europe. She says this is not just about Greece, but about a net of uncertainty cast across the whole of Europe, already creating volatility for the Kiwi dollars. Other countries such as Spain, Portugal and Italy are watching Greek developments closely. She says no one really knows what the wider outcomes will be, but potentially this crisis could derail a fragile global economic recovery, if not seriously impede the long-term viability of the euro currency. New Zealand companies need to review key contracts to ensure they have adequate termination, frustration, reservation of title and insurance provisions. Ms. Brown says, how can you be sure you'll be paid or that the goods you've ordered can be delivered? Will your hedging and credit support arrangements cushion you from the worst of the possible interest rate and currency disruptions? Firms need to check whether their contracts with European counterparties are clear as to where the risks sit and how they cover matters such as who owns goods sitting on a factory floor. She says the New Zealand Superannuation Fund's experience with lending Portugal's Banco Espírito Santo US $150 million, a sum the fund has written off as it fights Portugal's central bank through the courts, is an example of how business affairs can go wrong. She says little old New Zealand has investment tentacles everywhere, and from a pure business point of view, our business community is very connected worldwide. To the US economy, the latest job figures from the US reveals 223,000 jobs were added last month, resulting in the lowest level of unemployment in 7 years. But the labour force participation rate, which measures the number of people who are either employed or who are actively looking for work, dropped to 62.6%, which is an almost 40-year low. By comparison, New Zealand's participation rate is close to 70%. Westpac senior market strategist Imre Speiser says that although the data was a bit weaker than expected, some analysts were forecasting closer to 235,000 new jobs. It certainly wasn't bad enough to dissuade any analysts from changing their call for a September hike to something later. The US Federal Reserve did not raise its interest rates this month, which was no surprise to the market, but Fed Chairwoman Janet Yellen has hinted the long-awaited rate hike could come in September. She says no decision has been made by the committee about the right timing of an increase, but certainly an increase this year is possible. The job data will be welcome news for Ms. Yellen because she has iterated in the past how rates will be hiked when employment numbers were looking more favourable. Although the chairwoman and her Fed Reserve colleagues are optimistic the US economy will be ready for a rate hike, the IMF has warned the Fed to hold fire until next year. IMF boss Christine Lagarde says rates should be kept at zero until at least the first half of 2016, despite acknowledging the underpinnings for continued expansion in the US is still in place. CMC market analyst Sheldon Slabber says that although the headline employment number looks good, when the surface is scratched, it loses its shine. The figures show wage growth is stagnant, with average hourly earnings rising just 2% over the past 12 months, with the average US worker making $24.95 an hour in June. Mr. Slabbert takes a more dovish stance to the data and says it's a blow for Ms. Yellen's planned rate hikes. On May 22nd, Ms. Yellen said she would raise rates based on a 5% unemployment forecast and some other data. Mr. Slabbert says currently at 5.3%, and with a worsening participation rate, she's not there yet, and it's now more likely that the Fed will raise rates in September.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR. NBR Radio.